The United States is now the world's largest exporter of crude oil. That sentence should be impossible. For half a century, the defining anxiety of American energy policy was scarcity, the fear of running out, of being held hostage by foreign producers. The entire strategic apparatus, from the naval Fifth Fleet in the Persian Gulf to the Strategic Petroleum Reserve in salt caverns along the Gulf Coast, was built on a single, unshakable premise. America needed more oil than it could produce. That era is over. The country now pumps more crude than any nation in history, and it sells a staggering chunk of it abroad. In 2023, the US exported over 4 million barrels of crude oil every single day. That's more than the total daily oil consumption of Germany, France, and the United Kingdom combined. This is the energy historian, uncovering the hidden systems that power civilization. And this reversal from desperate importer to dominant exporter didn't solve a crisis. It created a new, more paradoxical one. To understand the sheer scale of this shift, you need to see the infrastructure that made it irrelevant. Forget the wellheads. The real story is in the pipelines, and one line in particular. For 40 years, the Capline system ran in one direction, south. It was the great artery of American energy dependence, a 40-inch steel vein stretching 632 miles from the oil hub of St. James, Louisiana, up to Patoka, Illinois. It moved foreign crude and Gulf of Mexico oil north, feeding the refineries of the Midwest. Its entire purpose was to service a nation that couldn't feed itself. Then, around 2015, the flow began to stutter. By 2021, it reversed completely. Today, Capline pumps American crude from the shale fields of the Midwest South to the export terminals on the Louisiana coast. A billion-dollar piece of critical infrastructure had its purpose inverted in less than a decade. The pipeline didn't change. The country beneath it did. The mechanism that flipped those pipes is deceptively simple. Volume. The shale revolution, through fracking and horizontal drilling, unlocked previously inaccessible oil from rock formations in Texas and North Dakota. U.S. crude production doubled in a decade, from about 5 million barrels a day in 2008 to over 13 million by the end of 2023. But here's the catch that most explanations miss. America didn't just find more oil, it found a specific kind of oil it wasn't built to consume. Shale crude is light and sweet-low in sulfur, easy to refine into gasoline and diesel. For decades, however, America's massive refinery complex, concentrated along the Gulf Coast, had been optimized for the exact opposite. It had retooled at enormous cost to process the heavy, sour, sludgy crude coming from places like Venezuela, Canada, and the Middle East. Those refineries are sophisticated, expensive chemical plants. You can't just switch the feedstock. So the US was suddenly drowning in a type of oil its own industry couldn't fully digest. This created a bizarre imbalance right at the heart of the system. Domestic light crude was plentiful and cheap. Refineries configured for heavy crude still needed their specialized diet. The market's solution was both logical and surreal. Sell the light oil to someone who wants it, and buy the heavy oil you need. And that's exactly what happened. American exports of light, sweet crude skyrocketed, primarily to Europe and Asia. At the very same time, imports of heavy, sour crude remained stubbornly high. In 2023, even as the US was exporting over 4 million barrels a day, it was still importing nearly 6 million. The country became its own best customer and its own biggest competitor. The system had decoupled. Production was no longer about feeding America, it was about feeding the global market. The real leverage point in this new equation isn't the well or the refinery. It's the dock. The ability to export at this scale required a second, less visible infrastructure revolution. For 40 years, a federal law known as the Crude Oil Export Ban made selling U.S. oil overseas largely illegal, a relic of the 1970s oil shocks. When Congress lifted the ban in December 2015, it unlocked a tidal wave that needed a place to go. Ports like Corpus Christi and Houston embarked on a dredging and construction frenzy, building deep-water terminals capable of loading the colossal VLCC's very large crude carriers that move oil across oceans. Corpus Christi went from a minor port to the nation's top oil exporter in under 5 years. The constraint shifted from geology to logistics. One port can now set the price for an entire continent. This is where the crisis was exported. The flood of American light crude didn't just give the US a new export product. It rewired global oil politics. For decades, OPEC, and particularly Saudi Arabia, functioned as the world's swing producer, the only actor with enough spare capacity to turn the taps up or down to stabilize prices. The US shale industry, with its rapid drilling cycles and thousands of independent producers, became something entirely new, a swing exporter. It couldn't control the global price, but its sheer volume acted as a ceiling. Every time prices rose too high, incentivizing more US drilling, a new wave of American barrels would hit the Atlantic basin within months, pushing prices back down. The leverage of petrostates didn't vanish, but it fragmented. Geopolitical risk was now diluted by a new constant source of supply that responded not to OPEC diktats, but to Wall Street financing and Texas mineral rights. This new stability created a deeper, more systemic vulnerability. The US energy system is now fundamentally schizophrenic. It is simultaneously the world's largest producer and one of its largest consumers, with a refining sector that operates as a separate, globally oriented entity. The gasoline in your car is increasingly less likely to be made from American crude. It's more likely refined from imported heavy oil, while the crude from a Texas shale patch ends up fueling cars in Shanghai. This creates a perilous illusion of independence. The supply chains have just gotten longer and more complex. A disruption in the Strait of Hormuz or a production cut in the Arabian Gulf no longer just threatens imports, it threatens the feedstock for the refineries that make America's domestic fuel. The system appears diversified, but its critical nodes are more exposed than ever. The financial mechanism that sustains this whole edifice is equally inverted. The shale revolution was built on debt. For years, drillers burned through cash, prioritizing growth over profitability, sustained by cheap capital from investors betting on ever-rising prices. To service that debt and generate returns, they must keep drilling and selling, often at prices that don't yield sustainable profits. The export outlet became a pressure valve, allowing this financial model to continue even when domestic demand stalled. Exports aren't just a market opportunity, they are a financial lifeline. The entire industry is locked into a cycle of production to meet financial obligations, not just market demand. Remove the export terminal, and the financial model collapses faster than the geology. So, how did America solve its oil crisis? It didn't. It bypassed it. The old crisis was about physical scarcity. The new condition is about systemic fragility. The nation eliminated the risk of having too little oil by creating a system that requires too much debt, too much infrastructure, too much integration with volatile global markets. The security of abundance is now predicated on the relentless flow of capital and the uninterrupted operation of ports thousands of miles from the wellhead. The Strategic Petroleum Reserve, that monument to scarcity, now sits alongside a daily export flow that is 20 times larger than the reserve's maximum drawdown rate. We didn't achieve independence. We achieved entanglement on our own terms. The final, unspoken trade is one of resilience for efficiency. The integrated, just-in-time global oil market is marvelously efficient at moving barrels to the highest bidder. But it is horrifically fragile to disruption. When a freeze knocks out Texas refineries or a hurricane shuts in Gulf production, the lost American barrels aren't just missing from US gas stations, they are missing from global balance sheets, spiking prices from Rotterdam to Singapore. The domestic market is now a direct input into global volatility. The crisis is no longer imported. It is manufactured locally and exported worldwide. Most people assume energy independence means you are insulated from global shocks. Drop your answer below. I'll break down why they have it backwards in the next episode. If this changed how you see the system, subscribe. The hidden infrastructure is always there. Now you know where to look.